Hey there, I'm Tony from Range. We're here with Paresh Batra, VP of Investments at Range. We're going to talk about the market as we head into a time of the year that's historically down. So Taresh, S&P 500 is at an all-time high. Volatility seems to be lower. The market hasn't had a 2% or more sell-off in over 90 sessions. September is historically a down month. Are you concerned about any of this?
Yeah, that sounds like a long streak, but we've had much longer streaks in the past. We're certainly not in excessive or extreme territory on that front. And it's true that volatility is lower and the market is at all-time highs. Counterintuitively, those are actually positive market signals. When the VIX or the volatility index declines for 4 consecutive months, returns have been higher 100% of the time looking out 9 months.
100% of the time.
Looking out 9 months. 80% of the time looking out 3 months. When you're investing at all-time highs, it feels a little bit scarier, but the data shows that your average 1 year, 3 year, 5 year returns are actually better than average. Over the last 5 years, we've had 3 bear markets in 2020, 2022, and 2025. Since 1950, we tend to have 1 bear market every 5 years. So we've certainly had our fair share of volatility recently.
Well, S&P 500 is at 22 times forward earnings, which is like the highest since dot-com bubble, except a brief period in 2020. Should we be concerned about valuations?
The valuation of the S&P 500 hasn't really moved all year. So the market performance year to date has been driven by earnings growth, which is what we expected to happen at the beginning of the year. Valuation ultimately is a reflection of the quality of the asset that you actually own. If it increases in quality, you would tend to pay a higher price for it. S&P 500 today is a much better asset than it was in the 1990s or the 2000s. Profit margins are significantly higher, balance sheets are significantly better, and growth is still very, very strong. And when you look at valuations, they're high, but they're not as high as they were back in the dot-com bubble. Companies today, large cap tech, is trading at around 28 times earnings. In the 1990s, leading up to the 2000 dot-com crisis, valuations had extended to 2 times that level. We are at higher than recent average valuation levels, but I think that there's a lot of differences between now and the dot-com era that make us less concerned about valuations alone.
Are we just temporarily propped up by AI investment, especially carried by the top tech firms?
Over the last few years, we have been carried by really strong AI fundamentals, high quality tech companies that are able to withstand macroeconomic headwinds, which has been positive for us that own the broad index that has a lot of exposure to these companies. So we do want breadth to expand. We want the rest of the investable universe to also participate in these rallies. We've seen in recent months more companies in S&P 500 start to participate in stock price momentum, valuations expanding a bit, and earnings revisions starting to move higher. If this happens, it means that investors are starting to express confidence in a broader set of companies, which is really healthy. The market becomes less vulnerable to the performance of a single sector, and the duration of this rally becomes more sustainable.
So what's one thing investors could be missing that might matter the most?
I think there's a lot of focus on near-term seasonality, near-term positioning, valuations. I think investors have to zoom out a bit and look over the next 12 months. We're entering a period where we have fiscal tailwinds with the tax bill providing some stimulus. We have deregulation, which is already underway in the banking sector. We have a weaker dollar, which supports US multinational companies. We have AI-driven CapEx investment and AI-driven productivity growth, which could support corporate earnings, all while we're likely to get more monetary easing. As an equity investor, the thing that I've focused the most on in my career is what companies are actually telling us, what they're expecting for future profit growth. Earnings trends and earnings revisions have been moving higher. And as long as earnings continue to move in the right direction, you can feel confident about market fundamentals.